Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us today. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. Shares of Alamos Gold are seeing a decline after the miner posted gold production in its latest quarter that came in below expectations. Full-year production also missed the mark. Alamos says the results were due to severe winter weather, seismic events, and mine work. The company's forecast for gold production also fell short due to lower than planned production from Canadian operations. Shares of Cogeco are rallying that after the company reported higher profit for its most recent quarter, and it came in above estimates. Cogeco says despite a challenging radio market, revenue also saw an increase compared to the year before, driven by robust growth in digital advertising. The company has reaffirmed its 2026 outlook. And also up, Bombardier, 3.87% right now. The plane maker is expanding its operations in Quebec with a $100 million project. Bombardier says the investment will see it opening a manufacturing center in Montreal that should come in 2027. The new center is aimed at supporting existing facilities as well as increasing production capacity to meet demand. And taking a look at the markets, it is a good day for the TSX, trading in record territory above 33,000. It's up 0.4% today, so that gangbuster start to the year continues for the TSX. And south of the border, nothing but green there too, I believe. Yeah, reacting to some tech stocks. And you can see S&P 500 up 0.67, Dow Jones 0.74, and the NASDAQ rallying. It is up about 0.88, 0.89%. Prime Minister Mark Carney says Canada is entering a new era of relations with China and that his visit to Beijing sets the stage for talks on areas where the two can be strategic partners. Let's get more on this and the markets from Christine Tan, Portfolio Manager at SLGI Asset Management. Christine, thanks as always for joining us.
Good morning, Roger. Thanks for having me. Although I'm remote today because of all the snow.
I think we're remote here, but I think we're just trapped here right now with the snow we're getting in Toronto.
Oh, dear.
China, though, it's nothing that looks like blue skies and sunshine and lollipops so far. Your thoughts on what's unfolding there?
You know, I think certainly our expectations were that if we got any announcements, it will come out towards the end of the week because Carney has met with Premier Li, but the big meeting is really tonight, or which will be Friday in China, with President Xi. So it's a bit of a pleasant surprise that we did see some MOUs come out overnight. Now, the key is these are memorandums of understanding. They're not contracts. But really, they cover some key points of key areas of potential collaboration, as you said. So, for example, energy, more specifically clean energy, things like cultural exchange, so tourism, etc., forestry management. These are areas where I think of it more as like knowledge exchange, and potentially it could sort of lead the way towards actual flows of goods. But early stages, and really our base case was really just looking for normalization and a reopen of the communication channel. China used to be basically our second largest trade partner after the US. And the U.S. continues to be a very important partner, obviously. But again, it behooves both the U.S. and Canada for us to diversify and think more broadly.
And how is the market approaching China with all these talks going on? Do they see the opportunities? Is there concern?
It's a great question, Roger, and it really depends on who you ask. So for us, for the TSX specifically, if you think about what sectors will benefit from, let's say, easing of trade, energy would be a main one. Now, as you know, the Trans Mountain Pipeline was expanded. It took quite a few years, actually, and the government had to get directly involved. but the TMX, as they call it, is fully up and running and operational as of 2024. So China is actually one of the biggest buyers of diluted bitumen that runs through the TMX. So that's interesting. But there is incremental volume going through that pipeline that could theoretically move to the China market, refinery market as well. And why I bring that up is, with what's happening in the potential increase in heavy production out of Venezuela, some of our heavy barrels that go to, let's say, Gulf of Mexico refineries will likely be replaced over the medium term. And so it's just, again, diversification. The other area of trade would be, obviously, the key areas that we're watching is canola. China has 100% tariffs on canola right now for coming out of Canada. And that's mainly in response to the tariffs that we have on Chinese EVs. So if you want to sort of really drill down on the key discussion, it's that canola / auto EV discussion.
That is,
and that could be quite meaningful for our economy.
That is everything. I mean, the EV one, it'll be interesting to see. Because backing off on the tariff for that with Trump next door is a tough call. With canola, I mean, we're seeing Nutrien reacting. It's on the way up right now on other things, but this could really fuel it, couldn't it?
It really could. And you have to remember that Canada is also one of the biggest exporters of potash in the world. Now, obviously, there are no direct tariffs necessarily, but these are some of the potential for expansion of trade when it comes to agriculture. So for us, when we think about sectors that particularly would be quite meaningful for Canada in these discussions, autos, agriculture, lumber, those would be three, and energy, obviously. So for now, I think the discussion that's happened so far is more around clean energy. So China's really been leading the way globally, partly because they're so much bigger than the next largest economy that's really implementing solar and wind in a meaningful way. So they've developed a lot of technology that really perhaps we could learn from or leverage as we try to become our own sort of energy superpower. So Carney's talked about the importance of really rethinking our role, Canada's role as a global energy superpower, and that embraces everything from traditional hydrocarbons, so oil and gas coming out of Alberta, that's a key growth area, but also alternative energy growth areas.
And now, of course, we also have to balance it with what's happening with the U.S. And I mean, the reality is they're still our biggest trading partner. How are things looking as we look ahead for the year for Canada in general?
Roger, if you told me I was going to start 2026 with some of the headlines that we've seen, I would have said, well, then the bond market must be reacting to some of these discussions around the Fed. Some of the noise perhaps in the oil markets, and we really haven't seen much of a reaction. So not entirely sure what that portends for the rest of the year. In a way, partly the market's become a little bit used to a lot of news. And now that earnings season is kicking off in the US, especially, Canada tends to lag a little bit in terms of timing. The focus is on, okay, what's going to actually impact the earnings of the companies that I own? And for now, because of that more granular focus, like you mentioned, TSMC overnight coming out with really strong numbers, I think that's what's keeping the markets really strong. But what we worry a little bit about is sort of that sense of complacency, and that perhaps any kind of earnings miss or any kind of pickup in geopolitical risk, there are a lot of things that could actually create volatility in the markets. And markets have been very strong year to date, so it doesn't give us a lot of room for error at this point. So cautiously optimistic coming in, because when we look at the fundamentals, Roger, the earnings outlook is actually quite favorable. Whether you look at S&P 500, the broadening out, even the TSX, you look at EFI, you look at emerging markets, corporate balance sheets are resilient. Our only sort of bugbear, if you will, is just valuations, especially for certain parts of the S&P 500 and global tech. But again, the actual fundamentals look okay.
Okay, well, we'll leave it on that on a happy note.
Yes.
Christine, thank you very much for joining us.
Thanks, Roger.
Christine Tan is portfolio manager at SLGI Asset Management. Coming up next, this high-stakes meeting with China's president tomorrow could reshape Canada's trade future. We'll continue to break it down after the break. We are starting to see some announcements coming out of China amidst the high-level meetings between Prime Minister Mark Carney and China's Premier. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. We weren't sure what was going to unfold, but we're starting to see some interesting things come out.
Starting to see some movement. Yeah, we thought maybe this would be more just kind of like a warming of relations, just some talks, but there are some documents being signed. And we know today Prime Minister Mark Carney was saying that Canada is entering a new era of relations with China. That's obviously part of the goal here, is to rebuild those relations. But when we're talking about some of the documents that are being signed, it's really interesting. We know now that the Premier of China, so that's like one step below the president. The Premier of China and Prime Minister Mark Carney, they met and they have signed some cooperative documents. So this means these documents, we could see some boosts in exports from Canada to China of oil, natural gas, and uranium. We know that a memorandum of understanding to strengthen energy cooperation was also signed. Obviously, that was some of the big item agendas heading into this, was potentially could we sell more of our Canadian oil to China now that everything that happened in Venezuela. China might be looking for some new partners in terms of oil imports to deal with. So that memorandum of understanding was signed today. And this also comes at a time when petroleum exports from Canada to China are ramping up. So we're seeing some movement on some fronts, but of course, there's still a lot to talk about and a lot of things for the Liberal government and the Prime Minister to consider here as well.
And of course, the big meeting with Xi tomorrow. Well,
that's tomorrow.
Late
Friday.
Tonight,
Friday, yeah.
Depending on how you want to look at it, it's midnight tonight, essentially.
Yeah.
So it's a big meeting. Now, not everything is lovey-dovey back here at home, though, with some of the premiers.
Well, that's exactly it. Like the big thing that came out the other day, obviously, was there are reports that China has said that if we ease tariffs on Chinese-made electric vehicles, China will ease tariffs on canola products that come from Canada. Obviously, we've heard Ontario Premier Doug Ford saying he doesn't want to see that happen in terms of tariff relief on Chinese electric-made vehicles. Obviously, he's speaking for the Ontario people. And of course, there was some production of electric vehicles supposed to be ramping up here in Ontario. But at the same time, you've got, provinces, Atlantic provinces, Western provinces pushing for the easing of those canola tariffs. That's hit that agriculture sector so hard.
Tariff,
seafood and pork as well, I believe. But canola in particular is just such a big exporter for Canada. And we know Scott Moe, the Premier of Saskatchewan, is actually on that trip with Mark Carney, which makes things a little bit more interesting. But we were also talking today just about how much Canada can open up trade with China. And Greg Taylor from Pefferin Capital Management was on the show this morning talking about how he feels that we should just be doing whatever we can to increase trade. Here's more on what he said.
Whatever we make, we should be trying to sell to China, I think. So there's opportunities here. Lumber is certainly one. Beef is something we should be looking at exporting. So I think energy is going to be the first one. Uranium is certainly something we can look at exporting more to them. And I think that's where we're going to start. But Canada as a country should be open to any deals we can do.
So got to be very careful, though. Obviously, I'm sure the United States watching these meetings closely. Yes. Donald Trump has talked about this before, and we know that there's a lot of tiptoeing around to do when it comes to trading with China and also trying to keep those relationships with the U.S. strong, especially as we head into free trade agreements later this summer. But yeah, it's going to be interesting, as you mentioned as well. Mark Carney expected to meet with Xi Jinping, the president of China, tomorrow, Friday.
All right, and we're going to go continue to talk about that a little more. Lindsay, thank you as always.
Thanks.
BNN Bloomberg's Lindsay Biscaya. Of course, this meeting is very important, including that face-to-face with Xi Jinping tomorrow. The stakes high as can be. So what does this mean for Canada's broad trade strategy? Well, Gil Land is an associate professor at the Toronto Metropolitan University, and he joins us now. Professor, thanks very much for joining us.
Thank you for having on.
It's a difficult line that the Prime Minister is walking right now, isn't it?
Very, very difficult. Many different things to balance, especially as mentioned before on your show about the different interests of the different provinces involved.
And how can he do it? Do you think? Is it? I mean, he wants to bring in new business. Great. He wants to appease the provinces, all of them, if he can. And then he's got Donald Trump to the south of him that I don't know if you want to appease or if you can appease, but you have to deal with him.
Well, I think there's a couple of points. This is an opportune time for the Prime Minister. With respect to the electric vehicles, which is first and foremost upon the Chinese government's mind, the European Union has actually set an example for us. The European Union has also imposed tariffs against Chinese electric vehicles, not as high as Canada. They did a proper subsidy investigation. And they just recently, a couple of days ago, came into informal agreement where if the Chinese manufacturers would propose a minimum price, which would offset any perceived subsidy, that perhaps if those vehicles could go into the EU without a tariff. Canada imposed tariffs at 100% without much of an investigation, presumably following the United States. So there is a mid-path that Prime Minister Carney could follow, just simply follow the EU, reduce those tariffs to whatever subsidy level Canada thinks it is, and then see whether or not it can just do the same thing that the EU is doing. That would perhaps make the Chinese government happy, as well as it wouldn't be giving everything away. It wouldn't be putting Canadians at a disadvantage. It would simply be leveling the playing field for Canadian manufacturers so that they're able to compete fairly and innovate and be efficient.
Do we know what the European numbers are, the base prices?
No, at this point, right now, they're still at the rough stages of it. Although they signed this informal agreement, but there will be proposed minimal prices, and then the European Union will have to see whether it approves them. But it certainly gets the ball rolling forward. You have concrete, proposal on the table that with official acknowledgments by both sides.
Now, I mean, it's one thing for the European Union to do that. They don't have Trump getting ready for negotiations with CUSMA, which he said, he's now said maybe we don't need it. We don't need Canadian cars. What kind of a reaction do you think that would garner from Trump if we were to say, you know what, we're going to lower the tariffs?
Well, I think it's very important that Canada not unnecessarily anger Trump, President Trump, but Canada's economic sovereignty is on the line, and diversification with our trade partners is necessary. So it may anger President Trump. At this point, I'm not sure whether not angering him would make much of a difference. But if there is an opportune time, this would be it, because the United States and China recently came to an informal truce in November, where they are relaxing export controls. There's been relaxation of the retaliatory tariffs. So given that there's a lull in the tensions between the United States and China, this is probably the better time, if at all any, for Canada to be approaching China, because for the United States to express its anger over Canada engaging with China might actually also disturb its very truce that it has with China right now. So this would be not necessarily a perfect time, but maybe one of the best times.
Could you see Canada coming back with a deal with on the EV or some kind of an MOU, and the same with canola from this meeting? I mean, we saw that the Premier, Scott Moe, was there from Saskatchewan, went for some of these meetings. Could we see something actually move on those two things?
I think that's a realistic possibility. China filed a WTO complaint against Canada. And as I mentioned before, Canada didn't really follow the same type of rigorous WTO subsidy investigation. And 100%, it's hard to imagine that the EU would be that off. Their estimations were anywhere between, I believe, 7 to 8%, all the way up to 35%. So the future road where this is leading is perhaps a loss for Canada at the WTO court. And Canada has been a professed supporter of multilateralism. It would no doubt have to follow that ruling in order not to lose legitimacy amongst its partners that it wants to diversify trade with. So at that point, it would have no choice but to either get rid of the tariffs or to lower them down to subsidy levels, the exact same level at where the EU is at. So I'm sure that must be on the radar of the Canadian government, where this path inevitably leads. So it would not be surprising if they try to come to some sort of deal, but very similar to what is going on with the EU. It's a very nice middle path compromise.
And if we do have deals like this heading into CUSMA, does this give us more of a position of strength, or are we in a weaker spot when it comes to negotiating CUSMA?
I think any diversification of Canada's risks, including with its trade, having more trade partners, puts Canada in a stronger position.
And what do you see with, I mean, as I mentioned earlier, we're talking about Trump saying we don't need CUSMA, we don't need Canadian cars. Do you see the negotiations happening? Do you see CUSMA surviving this, or maybe breaking it down into two different agreements, one with the U.S. and one with Mexico?
This one is really hard to tell. There's so many moving parts going on here. A lot of that will depend upon how the United States decides to treat Mexico and whether it decides to treat Mexico differently from Canada. If it does, then having CUSMA would not make sense from their point of view, their perspective. It would certainly be in line with their current strategy of negotiating bilateral agreements to maximize as much of their negotiating leverage. So in short, maybe there might be an attempt to do a free trade agreement with Canada and a free trade agreement with Mexico with different terms and conditions for each one of them. So anything's possible. And to me, that would be the most likely path if the United States were to continue on this very aggressive trade path that it's been taking.
Okay, we have to wrap it up there, but Professor, thanks as always for joining us.
Thank you. It was a pleasure.
Gil Land is an associate professor at Toronto Metropolitan University. Coming up, we'll have more on Canada and China, this time from an investor perspective from Greg Taylor of the Pender Fund Capital Management. The governments of China and Canada unveiled a series of cooperation agreements, including one with the goal of expanding energy trade. However, the document signed did not mention tariffs on canola or electric vehicles. To discuss this further, we spoke to Greg Taylor, Chief Investment Officer at Pender Fund Capital Management.
First off, it's a positive sign they're even talking. And we spent all of last year talking about trade wars and tariffs going up everywhere. And it's nice to start the year with some deals getting done, because we do know from comments from President Trump that he doesn't seem to be interested in renewing NAFTA or USMCA in Canada. So if they don't want to trade with us much, Canada has to find new trading partners. So we might as well go to one of the biggest economies in the world and do some deals.
And it's so tough with Trump, because it's like he doesn't feel like renewing CUSMA this week. We'll see what happens next week. So it makes it difficult to try and look at these outside negotiations. And I guess we do have to be careful about not selling ourselves short when we look for other deals. We don't want to look desperate going to places like China, because they'd be happy to take advantage of us, I think.
Oh, absolutely. And we're not in a great position. So I think everyone knows we need to do deals with our largest trading partner starting to be a little more aggressive against us. So whatever deals we can get are going to be positive. And you're right, President Trump, who knows how long deals can last, and he could flip his script tomorrow, for all we know, because it's a midterm election year and he's going to do whatever he can to win some votes. So whether getting a deal done with Canada is going to do that or standing tough against us might be the stance. So never know what's going to happen with the Americans. So might as well go and do some deals with other countries.
Now, with China, there was talk with energy to continue strengthen talks, I believe is the term they used, when it comes to oil and gas, resource development. Now, what does that mean? Deals are going to happen, or is that just right now we just kind of have to take that as it is?
Well, it is what they need and what we produce. So it's kind of something that has to happen naturally, and hopefully this will speed up the ability for Canada to get more export capacity out there. It would be nice to get some more LNG export terminals built, more pipelines built, so we can access to secondary customers and not just sell to the Americans. So I think they're saying all the right things, but again, it's going to come down to the details, see what actually is announced and whether we can actually get it in paper and start shipping stuff.
I'm just envisioning, thinking that we flip with Venezuela, and Venezuela is now shipping to the U.S. and we're shipping to China. Would this be the impetus, you think, for to expand the pipelines and push it through?
Well, it could be, and you bring a good point that Venezuela was shipping a lot of their oil to China. Now, if that supply is up in question, maybe China is looking for something to fill that gap, and Canadian oil is something that we should be able to get to the Chinese market. So, yeah, we do need pipelines, we need offshore capacity, and I think that's going to be something that everyone's starting to come to the table to realize, and something we should have done 20 years ago, but no time but the latter, right?
Mm-hmm. Now, and I mean, the talk has been focused on canola. That's been the big one, and the EVs. But do you see other opportunities for China that Canadian companies might be able to take advantage of?
Well, certainly the agricultural sector for sure is going to be something we can look at. So canola is something that we do want to get a deal on, and I think that's something that should happen this year. EV is a trickier one because that's involving a lot of technology, and I think that's become more of a hot potato with the U.S. So probably less design will do with the EV deal, but I think technology in general, we should be doing a lot more things, and Canada as an economy is still really struggling with some of the U.S. trade ties. So anything we can get and sell to that market, I think we should do.
And what opportunities, though, do you see beyond those two things? Or do you see other opportunities to go to products that we could be shipping to China? I mean, they opened up, apparently we can start shipping dog food.
Well, it's whatever we make, we should be trying to sell to China, I think. So there's opportunities here. Lumber is certainly one. Beef is something we should be looking at exporting. So I think energy is going to be the first one. Uranium is certainly something we can look at exporting more to them. And I think that's where we're going to start. But Canada as a country should be open to any deals we can do.
Okay. I mean, and there are some opportunities for, like when you look in Ontario, uranium, the Ring of Fire, and the critical minerals, but also nuclear as well. I mean, we were at the forefront for nuclear.
Oh, absolutely. The CANDU reactors are still some of the best in the world, and we need to really get this technology out there. I think the tide has changed on uranium and nuclear power, and I think with the whole power demand going up, we need to get more of this out there, and the CANDU technology is proven, it's been safe, and I think we should be building more of it throughout the world.
Okay. And when overall, at the end of this, will there be any big signings, do you feel, or is it just going to be, let's just kind of feel each other out and kind of get things back on the right direction?
It's probably still early days, so I don't know if we're expecting anything in the next 24 hours, but certainly we're heading into Davos. So there's going to be potentially more deals done there, and I think just in this year, again, is starting off way better than last year, where it seemed to be more trade wars than anything else.
And that was Greg Taylor, Chief Investment Officer at Pender Fund Capital Management. Coming up after the break, we'll take a look into Royal LePage's fourth quarter home price update and market forecast. That's next. Prime Minister Mark Carney says Canada and China are entering a new era of relations. Chinese Premier Li Qiang says Beijing is willing to deepen ties with Ottawa in clean energy, digital technology, and agriculture. Both leaders have signed cooperation documents which center around trade, energy, construction, and public security. Chiang says Carney's meeting with President Xi Jinping on Friday will pave the way for further upward growth. Shares of Goldman Sachs are moving higher. The lender broke an all-time Wall Street record after posting equities trading revenue that surpassed $4.3 billion in the fourth quarter. Revenue in its global banking and markets division also hit a record for the full year. Goldman boosted targets for its asset and wealth management unit and also raised its dividend. Shares of Morgan Stanley are trading higher, nearly 6%, after capping off a record-breaking year with a more than 90% increase in fourth quarter revenue from its debt underwriting. Total revenue and profit also came in above Wall Street estimates, and new assets in its wealth unit surpassed expectations. The bank says results were boosted by a rise in fees for advising on mergers and acquisitions. And taking a quick look at the markets, the TSX back in rally mode and back over, it's actually for the first time, over 33,000. It's up 0.45% right now. And south of the border, tech stocks helping there. You can see everybody's in the green after a couple of off days. S&P 500 up by 0.65, Dow by 0.81, and the NASDAQ by 0.87. In the fourth quarter of 2025, the national aggregate home price decreased 1.5% year over year. That according to a new report by Royal LePage, highlighting Canada's quarterly housing market trends. Let's get more on this from Philip Soper, CEO of Royal LePage. Philip, thanks as always for joining us.
My pleasure.
What are your thoughts on that number, the 1.5% decrease? Is it, are we hitting bottom, or where does it look like we're going?
You know, we've been treading water for some time now. And of course, the big story behind that aggregate national number is that some parts of the country with moderate home prices are actually showing some rather normal, healthy appreciation. And our two big metropolises continue to slide. So there is what, I think the last time we spoke, I mentioned this concept of compression in prices.
And where are we seeing some of the increases? Where are people moving to?
The biggest change in home prices to the positive continues to be in Quebec, and Quebec City in particular. Large public works projects there, a very, very tight housing supply. But we're also seeing robust markets as far away as Newfoundland, St. John's, Atlantic Canada is doing well. The prairies are fine. Even in smaller cities in Ontario and British Columbia, but Greater Vancouver, Greater Toronto continue to have soft markets, definitely a buyer's market in those regions, whereas the rest of the country, I'd put it in balanced market territory.
And do we know what's driving that? I'm just looking at that Quebec number. The year-over-year aggregate price increase, 13.2%. Do we know, is it people moving out of those two big cities, or is there money in those smaller markets?
Yeah, Quebec, for example, and we could use smaller cities in Ontario as a parallel. You've got the metropolis of Montreal. Home prices are much larger greater than they are in Quebec City. It's only an hour and a half, depending where you are in Montreal and where you're moving to in Quebec. It's a short change in lifestyle for more affordable housing, and the employment situation there is very strong. But we could paint that picture across the country. What we saw start in the pandemic, when people woke up to the fact that if you lived in Toronto, you were paying 3 times as much for a home as, say, living in Calgary. The invisible hand of the market is working its magic, and after a few years of just slightly sliding prices in Toronto and rising prices in these other cities, like Calgary, for example, what was 3 to 1 is now 2 to 1. So it will impact interprovincial migration patterns, and we'll see less people leaving our 2 biggest cities for other parts of the country.
And is that the back to work that we're seeing with a lot of places, especially government-rich cities like Ottawa, Toronto, and bank cities like Toronto, Montreal?
Yeah, you know what? Back to work is definitely supporting segments like the beleaguered condominium segment. We could use an easing of the restrictions on immigration, foreign students, that sort of thing, to boost our condominium market in big cities. But failing that, we are seeing back to work, having people look at living in city cores where they were quite comfortable with coming in for a couple of days a week with a 2-hour drive, but not when it gets to 3 days a week or 4 days a week.
Mm-hmm. And what are we looking for as we head into spring? Is there a pent-up demand almost that people eventually are going to have to move?
Absolutely. The trade concerns, the geopolitical tensions, which have hammered consumer confidence. It's not so much that they're easing, as you know, but it is that people are adjusting to it. They're not waiting for perfect or calm on the world stage. They're seeing progress being made from a Canadian perspective, and they're getting on with it. So the spring market will be our busiest market, as it is every year. We're not expecting a ricochet or a roller coaster scream to the top of the curve during the spring market, but there will be pickup, and we are anticipating for 2026 that by the end of the year, prices will be up 1% over the year before. So essentially flat, but positive flat.
And what kind of an impact, are we seeing rent prices drop, and are people deciding that they just want to stay maybe in a rental rather than look at buying and take on the responsibilities of buying? Is that having any kind of an impact?
Absolutely. Rents, they're very attractive in big cities right now, not in Quebec City or St. John's. So if you've got a tight for sale housing market, that usually translates into a tight rental market. But they're very favorable in places like Toronto or Vancouver. And that is attracting more buyers to the segment. It's challenging for small investors, though, to get into the market right now. And they are the ones that provide a lot of the rental stock in Canada, people who own 1, 2, 3 condominiums as a like a form of retirement savings, like an RSP, and they're challenged because they don't have the volume of people they did before the sharp curtailment of newcomers.
Okay, we're going to have to wrap it up there, but Philip, always a pleasure talking with you, sir.
My pleasure.
Philip Soper is CEO of Royal LePage. Coming up, Morgan Stanley and Goldman Sachs have reported their fourth quarter results. We'll break that down when we come back. We're getting more fourth quarter earnings results from the U.S. big banks, including Morgan Stanley and Goldman Sachs. Earlier, we got reaction from Martin Cobb, Senior Vice President of Equities at Lawrence Steinberg Wealth Management.
Obviously, today's banks, Goldman Sachs getting out of the consumer business, Morgan Stanley increasingly a wealth management business, less concerned for those individual businesses in terms of what happens with capping, say, credit card interest rates. But we came into the set of results. Hands up anyone who thought they wouldn't have bumper results. They did. But we came into this year with valuations, a number of these stocks. We own all three, actually, of the investment banks, the US, but have been taking a little bit of money off the table because valuations are up there.
So they're expensive, these big US banks, generally?
Yeah, I'm a former bank analyst. I won't bore you about the years I spent in banks' balance sheets. And I tend to look at price to book as a much better metric of valuing banks. They say price to earnings, just because the volatility that you have in earnings. I mean, Goldman Sachs in 2025 earned twice as much as it did in 2023, and who knows what it'll earn in 2026. So on price to book basis, the valuations are between 2.5, 3 times book value, for returns on equity in the kind of mid-teens. Now, that's higher than we've seen since any time since the global financial crisis. Indeed, for JP Morgan, higher than we've seen since the early 2000s. So a lot of good news baked into these share prices coming into this year. So no surprise from me that even with bumper results, good outlooks, that the shares prices have been a little bit soggy.
The TSX hitting record highs, fueled in part by gold stocks. I know it's hard to generalize about a market, but what interests you in Canadian stocks right now, Martin?
It's getting harder, Andrew, to find attractive stocks within in the Canadian market. We know how well the precious metal stocks have done, the gold stocks, the banks last year. Some of the retailers have done particularly well, like Aritzia and Dollarama. But there's always stuff under the surface, stuff that no one's talking about. I mentioned a couple of times, the railway stocks, I think are great long-term purchases in these levels. And there's always something with a little bit of a, concern about it in the short term that ultimately may prove to be a very attractive entry point in the long term. But it's harder today because aggregate valuations, our banks too, are not exactly cheap. Aggregate valuations are up there.
Let's maybe have a look at a 5-year chart for CP and for Canadian National Rail. Obviously, those stocks were under pressure last spring because of fears over Trump's tariffs. And that's interesting. Actually, then they rallied, but then went on dropping. They have recovered a bit. You think investors may be missing value in the railway stocks?
I just don't think these businesses have changed all that much over, they've been around for 100 years. They'll be around for another 100 years. And if you look back, there's always some reason to be negative on their whales. And so today's tariffs, previously it was wildfires, then it was bad harvests, government interference. There's always something. But these are, your classic, high barriers to entry, extremely high barriers to entry, businesses. You cannot replicate them. As I say, they'll be around for decades. They'll continue to shift a bit more volume, every year that they do, through thick or thin, and they'll have a little bit of pricing power. The difference between now and, say, 5 years ago is they're trading on 2/3 of the valuation because they're just, people are concerned about tariffs, people are concerned about trade. Quite, I say not surprisingly, but, this too shall pass.
Yeah, I see CP Kansas City has had some bargaining pacts in the U.S. ratified. It's not huge. I think it's 700 railroaders, but it looks like one labor problem has gone off their, or a potential labor problem is off their radar there. You have some stock ideas for us. Automatic data processing. What do they do and why do you like them, Martin?
Yes, ADP, as we would typically call it, is largely a payroll processor, the world's leading payroll processor. 1 in 6 American workers will have their payroll processed by ADP.
Wow.
I have my payroll processed by ADP. It is just a phenomenal business. They handle between 2 and 3 trillion of clients' money every year. They sit on roughly 40 billion at any one time. There are competitive threats, but you don't want to mess with this baby if you are any company, processing your payroll. So the competitive barriers to this, I think, are very huge. They've grown their revenues every year this century. So even during the global financial crisis, unemployment rising, etc., they still grew their revenues on an organic basis. So huge barriers to entry, long-term secular growth, maybe have something like 10% market share. A lot of it's still done in-house. And ultimately, you're getting very dependable growth, expanding margins, maybe something like 10%, 12% earnings per share growth on a sustainable basis for the long term, trading on close to 20 times multiple. It's just one of those high quality industrials that today seems a little bit forgotten about.
That's interesting as well. Switching, I mean, who's going to want to switch that kind of data processor if you can avoid it? Yeah, you just imagine the bureaucratic hassles.
Their software, I'd say, is a bit clunky, but it doesn't matter. It's just they do what they do. It's a very low cost for a business to get them to process your payroll. They are embracing all the new regulations, etc. And it's just hard to get them out of your business once they're in.
Finally, Linde, a huge global player in industrial gases.
Yeah, this is, again, another high-quality industrial that I believe looks very attractive today. We saw the news with TSMC. So if you're building a semiconductor plant, you need high-quality gases. I mean, very high-quality gases. They talk about the 5 nines, 99.999% purity, of a whole host of gases for semiconductor plants. The same with petrochemicals, hospitals. There's so many mission-critical gases that these companies provide. What Linde does, and Air Products or others, Air Liquide as well, is they build the plant right next door to the semiconductor plant. It's basically on site with a 30-year contract, typically, providing those gases. And then you can sell any excess into the merchant market. Again, huge barriers to entry. There's only 3 companies really in the world that do this, dominate the market, mission critical, very low cost in terms of the cost of the overall production of the client. But again, a bit like ADP, once they're in there, very hard to get rid of them.
And he was speaking with Martin Cobb, Senior Vice President of Equities at Lawrence Steinberg Wealth Management. Just ahead, the cost of an average home in Canada fell 2% from last year. More on that. Well, the actual national average sale price of a home sold in November, it was $682,219. That's down 2% from a year earlier. For more, we were joined by CTV's Kamal Karamali.
There will be more homes that exchange hands in 2026, as well as the average price of a home or a property is going to go up. That is according to the Canadian Real Estate Association's forecast for 2026 and for 2027 released this morning. And what it essentially says is that there's a lot of pent-up demand from first-time home buyers, especially who've been waiting to enter the market, but the increase in the interest rates as well as the housing prices have really shut them out of the housing market in the past 4 years. So this is their gate into the housing market, and the floodgates are expected to open in 2026. So let's take a look at some of the numbers that we have here. So right now it's saying this report that roughly what we've seen here is that roughly last year we saw about 470,000 homes exchange hands. That's set to go up over 500,000 to 511,000. So an increase of 5% of properties will be bought and sold in 2026. And the average price of a home across the country was $679,000. That is expected to go up 2.8%, up to $698,000. So almost $700,000 $63,000 is going to be the new average price of a home, according to this real estate forecast. Probably no surprise here that the most expensive pieces of property on average are going to be in BC and Ontario in 2026, with BC being $975,000 on average for a home in British Columbia. That is up 2.3% from 2025. And in Quebec, or rather in Ontario, $842,000 is going to be the new average estimated price for a home in 2026. That is up just under 1%, 0.8% increase over 2025, but still an increase and a pretty expensive price to pay for a piece of property. Once again, two of the more expensive provinces where you will have to pay quite a bit to buy a home. And then once again, these Canadian Real Estate Association forecasts also give you a little bit of a snapshot into 2027. And because there's been so much pent-up demand, especially once again from these first-time home buyers who have been waiting 4 or 5 years to enter the market, they're also expecting 2027 to have an increase in the number of homes exchanging hands, as well as the increase in price as well in 2027. So only upwards from here when it comes to the number of homes bought and sold and the prices as well.
And that was CTV's Kamal Karamali. Let's take a quick look at how the markets are performing. First up is Bay Street, and it was over 33,000. It's just dipped below. It's still up by a quarter point, and it's in a good little roll again after that soft day. And leading the way, actually, real estate is one of the better performing indexes right now. South of the border, you got the S&P up by 0.71%. The NASDAQ, led by some tech stocks, it's up nearly a full %. And that is it for Morning Markets. Thanks for watching. We'll see you back here tomorrow.